This series of 4 sections, including this introductory section, discusses the financial structure of a subsidiary. When thinking about the financial structure of a subsidiary, we're thinking about 2 principal things. First, what the balance sheet of the subsidiary will look like, and secondly, how to make tangible and intangible assets available to the subsidiary so that it can conduct its intended business. The second section of this 4-part series, which lasts about 30 minutes, discusses a few introductory things. These include some relevant basic accounting concepts and comments on the nature of the balance sheet of a subsidiary, as well as the need or lack of need for assets, tangible and intangible, to be recorded on the balance sheet. The discussion also asks the question of who cares what the subsidiary's balance sheet looks like. The third section of this 4-part series, which lasts about 25 minutes, discusses a number of factors and constraints that can affect financial structure planning. These include certain operational and economic factors, various legal protection issues, and a number of taxation matters. The 4th section of this 4-part series, which lasts about an hour, discusses various mechanisms for making assets available to a subsidiary. These mechanisms include transfers in exchange for newly issued shares, contributions to capital where no shares are issued, sales, and leases and licenses. In addition, there is some discussion of local loans involving parent company guarantees and thin capitalization rules. The context of this 4-part series discussion is that the students were assigned a relatively complicated case study that involved a U.S. manufacturing company, ABC, setting up manufacturing subsidiaries in 2 countries that would be chosen by each student. The new subsidiaries would locally manufacture food products currently being manufactured by ABC only in the U.S. ABC has designed and built its own food processing machinery, and the new subsidiaries would use this proprietary machinery in its local manufacture of breakfast cereals and food bars. In brief, the case study facts include: first, ABC will self-manufacture certain food manufacturing equipment with an out-of-pocket cost of $10 million and a fair market value of $15 million. This equipment will be used in the local manufacturing operation. Second, ABC owns various intangibles that will be used in the local manufacturing operations. And thirdly, ABC has excess foreign tax credits. Although the students are free to recommend some other form of organization, this discussion on financial structure assumes that they have recommended that a local subsidiary be formed to conduct the local manufacturing operations in each of their 2 chosen countries. Accordingly, there will be a local subsidiary balance sheet, and it will be necessary to determine how ABC, the U.S. parent, will make available to each subsidiary the tangible and intangible assets necessary for its intended manufacturing operations.